The real reason Dubai has no property taxes. Imagine buying a 2 crore villa in Dubai and earning around 8% rental yield completely tax-free. Every rupee you make, you keep. Now compare that to Mumbai, where close to 30% of the same earnings vanish in taxes. The contrast is hard to ignore. This single difference explains why global investors continue pouring billions into Dubai's real estate market. But it raises a deeper question. Why does Dubai operate without property taxes? And more importantly, can this model actually last? In the next few minutes, we'll explore how all wealth first made this possible, how Dubai shifted to new revenue streams beyond oil, and whether this tax-free advantage will survive beyond 2030. Dubai's tax-free model didn't appear overnight. It was built on the massive oil boom of the 1960s, when oil exports began transforming the region's economic destiny. By the 1990s, oil revenues had pushed the UAE's GDP close to $20 billion, generating enough capital to fund infrastructure without taxing residents or property owners. At the time, oil and gas contributed nearly 40% of the UAE's GDP. Instead of introducing property or income taxes, the leadership made a strategic decision. Use oil wealth to build the nation while keeping taxes minimal to attract global talent, foreign capital, and long-term investors. Roads, ports, airports, luxury malls, even icons like Burj Khalifa, all funded by oil revenues. At its peak, oil revenues enabled annual investments of nearly $100 billion. This zero-tax environment attracted an expat population that now makes up almost 90% of the country. This sharply increased housing demand and turned real estate into one of Dubai's strongest economic pillars. But today, the story has evolved dramatically. Oil now contributes roughly 30% of the UAE's GDP, and in Dubai specifically, that number is even lower, estimated between 1% and 5%. This shift is the result of long-term diversification efforts, most notably the D33 Economic Agenda, which aims to double Dubai's economy to $1 trillion by 2033. Non-oil sectors now account for nearly 97% of Dubai's GDP. Tourism continues to surge through attractions like the Dubai Mall and major events. Trade flows through Jebel Ali Port, one of the busiest in the world. Finance, technology, and real estate continue to expand. In fact, property transactions alone are projected to cross AED 680 billion in 2025. Instead of taxing property owners, Dubai generates revenue through visas, licensing fees, tourism levies like the 5% hotel tax, and a 9% corporate tax on profits above AED 375,000. Importantly, individual investors and landlords remain outside this tax net. As of 2026, there is still no annual property tax in Dubai. The only mandatory real estate cost remains the one-time 4% Dubai Land Department transfer fee at purchase, along with the standard service charges that typically range between AED 10 and 20 per square foot. Looking ahead, the model appears structurally strong. Keeping property income tax-free is central to Dubai's global competitiveness, especially as oil reserves are expected to last another 40 to 60 years. Meanwhile, the D33 strategy is already positioning the city as a leader in renewables, artificial intelligence, and future technologies. The risk of sudden property taxation remains low. Global financial hubs like Singapore maintain relatively low taxes to stay competitive, while Dubai goes even further by offering zero capital gains tax and no inheritance tax. For investors, this creates a clear window of opportunity to lock in yields under a highly favorable regime. Dubai's tax-free real estate model is not a temporary loophole. It's the result of decades of strategic planning and smart economic diversification. For now and for the foreseeable future, tax-free property gains remain a core part of Dubai's investment appeal. If you want more insights like this and updates on what could change in 2026 and beyond, make sure you subscribe.